Diane Lin is a fund manager at Pengana Capital, which oversees $1 billion. She joins us from Sydney this morning. Diane, why the cautious take on China? What risks do you see in China right now?
Investing in China for the next at least 6 months, we see two major risks, all related to liquidity, both internally and externally. Internally, obviously, the Chinese government's tightening process, we believe, is just started. And it will be a lot of uncertainties going forward, whether it will impact economic growth, particularly towards the second half this year. And externally, also, we are facing a very unfavorable liquidity environment, not just for China, but for the region as a whole. That is, the central bank in the US is normalizing its monetary policy, which has been extremely accommodative from last year. So these two risks are raising the uncertainties going forward, particularly in China at the moment. A lot of economies are forecasting the GDP growth to be around 9 to 11% this year. We think there might be a risk this number to be revised down if the tightening policy is very effective, particularly targeting at the fixed asset investment.
So what does it mean for the markets? The Shanghai Comp down 9% year to date. How much deeper will it be?
Oh, that's a very difficult question. We think, considering like a lot of investors at the moment or some market observers comparing the current situation to 2004, at that time the market actually corrected well over 20%. And I don't think 20% correction it's substantial. There might be another a bit more downside risk going forward. However, what's very interesting though, China itself has corrected quite a lot, but the markets outside China, particularly the sectors exposed to China growth, actually hasn't corrected substantially. We actually see more risks in markets outside China than in China, like Australia. I mean, for example, the Hang Seng China Index already corrected nearly 20% from the peak a couple months ago, but Australia, for example, has only corrected less than 10%. So we actually a little bit more cautious in markets like Australia or the other regional markets that are exposed to China growth.
So despite the risk, you can still play the China market. And for yourself, you like Lenovo, which is apparently your biggest holding in China. You're saying the stock is worth much more than it is right now.
Lenovo is a very interesting company. It has gone through a substantial downgrade in earnings, and the operation has also experienced quite a lot of tough time. But from the most recent results, we have seen the margin starting to improve. At the moment, still only EBIT margin less than 1%. If he can go back to his historical range, around 4 to 5%, the stock could be worth twice as much as current price. So we do see, and China's growth in, particularly China's demand for PC and consumer electronics, we think will be a major driver for Lenovo's fortune going forward. So we are cautious on China, particularly the housing market, but we are quite comfortable with companies exposed to the consumer sector like Lenovo and some of the LCD TV companies.
What would prompt you to revise up Lenovo's share price? Because we know Goldman lifted its target by 30% this month.
We need to see more improvement in its top-line sales. As you know, it also has a decent exposure to the US PC market, particularly the corporate sector. So if that part of the business starts to recover, and that will be a major benefit to Lenovo, because at the moment the cost control is very well in place. Any top-line growth will feed straight to bottom line, and that will substantially improve its margin, and as a result to its further upside to the share price. And of course, China's growth is important as well.
Diane, TCL Multimedia, another company you like. Why is that? How much more upside are you looking at?
TCL in a way is quite similar to companies like Lenovo. It only until very recently starts to see its fortune to turn. Its sales start to pick up because of the very strong demand growth for LCD TV. This market is substantial in China because we are looking for replacement demand, LCD TV to replace CRT TV. So TCL is one of the major beneficiaries. Is one of the top 3 suppliers for LCD TV in China. So, I mean, depending on, based on our current analysis, this company can offer quite a strong growth this year and next year. So it's a structural change for the company.
Diane Lin, Pengana Capital, thank you so much for your insights today. Diane liking Lenovo as well as TCL Multimedia.